Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Max Sharkansky. Since 2005, Max has led the acquisition, renovation, and disposition of over $800 million in mismanaged and distressed assets, primarily in multifamily. He started his real estate career as a senior associate at Marcus Millichap in 2002. So thank you so much for being on.
Thank you for having me. Great to be here.
So give us a little background on yourself prior to getting involved with your own company right now.
Well, I was born and raised in Los Angeles, California. Went to high school, college, did everything in LA, went to LMU, graduated college. Once I was in college, I knew I wanted to be in real estate. I was in college during the time of the dot-com bust, and a lot of that just didn't feel right with what was going on in the stock market. And I really loved the idea of a tangible asset, which was the exact opposite of what dot-coms were at that time, at least. And, you could see it, feel it, touch it, and it just looked really cool and sexy. And look at these beautiful high rises in the sky. Little did I know that's not what I was going to be working on, but it just seemed really, really cool at the time. So I started getting into real estate after college. I got into real estate at Marcus Millichap, got a job in their internship program, and then became a broker. Once I was in brokerage, I started to, look at some of the other guys in the office that were buying some deals, and they were doing very, very well on them, as were my clients, of course. And that's where I wanted to be full time. So my partner, Mitch, and I started buying end of 05, early 06. He was on the debt side at HFF. And he was the same thing, he didn't want to be on the sell side forever. So we started buying and bought our first couple properties end of 05, continued buying into 06. And then we left in 06, hit the ground running and aggregated a small portfolio during the last cycle. We were fortunate enough to have really good timing and sell most of it in 08 prior to the crash. It wasn't anything huge. It was a pretty small portfolio, but we did sell it in time. And as we were selling, we changed our model from value-added multifamily to buying non-performing debt secured by multifamily. So as we were selling, we were calling banks. A lot of the originators we had been dealing with over the years had become asset managers, and we were calling them to try to buy notes. It was a log jam the first year and a half or so. The bid-ask spread was just so huge. We were trying to buy notes at like 60 cents on the dollar, 65 cents on the dollar. They were trying to sell them for 97 cents on the dollar. We would call them, they would practically hang up on us. And then, once the shit really hit the fan in 09, we bought our first few notes from a bank in LA. And from there, it just snowballed. And we had a very active downturn during the GFC. We did about 20 deals, about 15 of which were non-performing debt deals, and about another 5 REO deals. At the time, we were very, very competitive because a lot of the people buying notes were ex-finance guys who were just, their model was buy, foreclose, flip. Whereas we had a infrastructure in place with a crew and property management. So our model was buy, foreclose, renovate, lease up, and then sell. So we could get a lot more aggressive with what we were paying, and we were able to buy a lot of deals. So we actually had a very successful downturn. And then coming out of the downturn, when the market cleared, end of 12, early 2013, we picked off our last REO, and we just went back to the value add business. And now we've got a little over a couple thousand units in portfolio, and we've probably done 5,000 plus units total. So yeah, here we are. We just opened an office in Miami, Florida. I personally just moved to Miami 3 weeks ago today, and really excited about the expansion.
Nice. That's awesome. It's interesting. You said it took about like a year after for the banks actually to come to terms, or the sellers to come to terms, that the market is pulled back. And I always find that because it happened to me in '09 when I was buying properties, and the deals didn't come up until like end of '09. And I think at the end of '08, they were still like, oh, everything, And then I think in '09 and early 2010, they came to terms like, oh yeah, this is the only way we're going to be able to sell this, is that we have to discount this. And they're accepting, they'll listen to you for even crazy offers you're making, and they'll counter even crazy offers. So it was a very interesting time and wild time during those years. But so after buying REOs, how has your strategy kind of moved, progressed to where we are now? And what are you really focusing on now? Most syndicators are really focused on doing light value adds. Obviously, you guys have like a construction company, a management company. So you're doing, I would imagine, more heavy value add deals. Is that correct?
That's correct. That's what we've done historically. When I say historically, I mean, since 2012, 13, during the downturn, it was very heavy value add. I would say it was more opportunistic than value add, because during that period, we were buying properties that were 40, 50% occupied, heavily distressed, just needed a full repositioning. Then coming out of the downturn, we went back to just a heavy value add model, and we're buying product we were buying on the West Coast in very high rent growth markets that were going through a lot of change. So we were able to spend a lot of money on assets that had really been neglected, and I shouldn't just say neglected, but they hadn't really been driving rents because there was so much change happening and so much rent growth. And markets for example, like the East Bay where we were buying, East Bay used to be a sleepy suburban market, and what it had transformed into was a feeder market into San Francisco with people that make six-figure incomes. Like most of our properties in the East Bay today have average household income of six figures or very, very close to it. And that hadn't been remotely close to being the case. So because you had such a strong demographic, you're able to really reposition an asset, make it very, very nice, and create almost, your own asset class in between Class B and Class A.
Interesting. What type of debt are you guys getting on these heavier adds and these repositions?
Traditionally, it's bridge. We had a really nice run in the last couple of years with agency buying in, and we still do continue to use agency, but right now it's mostly on refis. Cap rates have compressed so much over the past, I would say 3, 4, 5 months. That has unfortunately gone out the window with agency, and stuff trading at sub 4 caps going in. It's very, very difficult right now for us, on the heavy value add stuff, to buy with agency debt. We did just close one, but it was a newer vintage deal that was a more light value add. So we can use agency debt with more light value add, but on the heavier value add stuff where you're buying at sub 4 caps, it's bridge, 70% loan to cost, L3.
Yeah. Okay. Interesting. Yeah. So, because you're not usually on something like that, you're probably not going to be able to get agency with that heavy of a rehab, and they're probably not even at 90% for 90 days on the occupancy front.
Right. Exactly.
Yeah. So let's, you guys do a lot of these rehabs. How are you? Because I get this question. I just got this question actually yesterday from someone I was speaking to, and they're planning out a rehab and making sure they're not to over improve the assets. Now you're going into these areas that are really gentrifying, like your East Bay, what you're talking about there. How do you kind of plan it out so you're not over improving? And is it just running and really touring these comps? Or are you kind of going in and just as like being an outlier, and you're going in and kind of just saying we can push it because the demand's there? Like, how do you define kind of how we're going to finish it and how much we're going to put into each unit?
That's a great question. Well, again, these areas are going through such rapid change. When you're entering a new market, you really don't know until you just do some old-fashioned trial and error. So you go in, you have a certain budget for, let's say, a high octane reno, and you're going to spend whatever it is, $15,000, $20,000 a unit in areas like the East Bay. And you are going to, let's say, quote unquote, over improve it in the beginning to see if you are in fact over improving it. So, you sample a few different specs of renovations, and if you're able to charge premium rents for every dollar that you spend on renovations, then you just roll with that, right? So if you're spending, for example, $20,000 a unit, and you see that you're getting a substantial premium over to what you'd be getting $12,000 to $13,000 a unit, then you roll with that renovation. Or if it's, $12,000 to $13,000 a unit, $15,000 a unit versus something that's $7,000 or $8,000 a unit, which is what we're doing right now in Sacramento. We bought a deal last year in Sacramento. We were thinking, it was kind of be probably like a $10,000 to $12,000 a unit, like nice renovation, but nothing too crazy. But we found that we have been able to get a premium on that $13,000 to $17,000 a unit, and that's a pretty wide range. And I give you that range because that includes a washer dryer. So, that maximum renovation for that market, we found that there is a demand for it. So we're continuing to do that.
Yeah. So it's like a trial and error and kind of like getting proof of concept on different finishes before you go through the whole property with them.
With the first property in that market, right? So
first property in the market. Okay, there you go.
So yeah, exactly. So for like this deal, we haven't bought anything in Sacramento in years. And we bought that deal in Sac, and now we know how that particular submarket of Sacramento is going to respond to the renovation. So moving forward, that's what we'll do as we acquire assets in that area.
Yeah, that makes sense, because when you're going into areas that are you're riding that gentrification wave, you might say, I'm driving through a neighborhood and this has been renovated, that's been renovated. This is what they chose for doing finishes, but you might be a block or two away and it might be different. I mean, it might be a completely different how, you might be going for the stainless steel and granite versus something a little bit less expensive. Sounds like all yours are very high end, but when we're working like in a B- area, that's C+ area, that's kind of stuff and questions that we have come up. But so you own a lot of these assets in tenant friendly states, like I see a lot of Oregon, see a lot of California. How are you maneuvering and owning and managing properties in these states, especially with what we've been going through here, which is still continuing in those states with these moratoriums?
Well, that's part of the reason why we opened a new office in Miami to cover a region of the country that's a little more business friendly. So, here we are covering the Southeast, Florida, Georgia, and the Carolinas. And it's just much more easier to operate here. So we don't have to deal with a lot of those headaches. And, when I say headaches, I don't mean just the existing regulations. It's also moving of the goalposts, right? So, the problem with California and Oregon, I'd say the main problem, and some of these markets, like New York and some of these other markets, is you just don't know what they're going to do next. I'd say that's the main risk, is with one stroke of the pen, everything changes. A lot of the regs that they've put in place over the past few years, like AB 1482 in California and the rent stabilization in Oregon at the state level, we can work pretty well within that framework, because California is 5+ CPI, Oregon is 7+ CPI. So hypothetically speaking, if CPI is 3%, so Oregon you can raise rents by 10, California you can raise rents by 8. So on a hold of 2, 3, 4 years, you're able to get to market. So that's the easy part. The hard part is just not knowing what they're going to do next.
Yeah, I could definitely see that. Because also they can take that, what you just said for the accepted rent increase, and they might shave off 2 points off that and overnight, and you don't know. And now when you're talking to investors, now you've added another year or two to the timetable of when you're trying to achieve these rents for all the finishes and for all the work you've done. So I can see how that could be aggravating, and to say the least.
Yep, exactly, to say the least.
So with your firm being, you have a vertically integrated firm, you're handling property management in-house, you're handling construction in-house. How does, as I've spoken to other operators before that have this, and usually it's for more control, or is this really adding this in-house? Is it for an additional profit center, or is it just so you can, exactly what costs are, you have a better handle on that, and you can kind of control the project a little bit more hands-on, I guess you would say?
Absolutely the latter. It had not been a profit center for us for years. In fact, we lost money because we always had a higher payroll than we did fees coming in from property management and construction management. It was really, in terms of just like looking at the fee income, but the way we looked at it is, okay, if we have great talent in-house and we're able to control cost efficiency, time efficiency, then we know we'll ultimately have a higher NOI, we'll have much better product, and we'll sell it for more money. So everybody wins. Our LPs make more money. We generate a higher IRR. We, of course, then make a higher promote, and that'll cover all those costs. But we'll lose money along the way. So it was kind of sort of like a loss leader for us. Now that we've gotten more scale, I would say we probably break even more or less on the property management part of the business in terms of fees. But again, it's not just about the fees, it's about the creation of value in the asset and getting the highest return possible for our investors.
Okay, that's a great answer. So how is your investment strategy and criteria currently right now? I mean, after moving down and kind of focusing a lot on the Southeast, are you still focusing on similar B plus A minus assets? Has that transitioned at all? What are you guys really looking at? And what's your criteria and strategy down here in the Southeast?
So in California and Oregon, there's a lot of 70s product. So we buy a ton of 70s on the West Coast. Same with Colorado. We're in Colorado as well. It's a mix of 70s and 80s. Here in the Southeast, they've done a really great job over the years just building and creating a lot of product. So here we probably wouldn't buy as much 70s product, but there's a ton of 80s and 90s and 2000s, and here they just kept building. So there's a lot more to buy and there's a lot more new product to buy. And when I say new, I mean like 90s and newer. So we just got awarded our first deal in North Carolina, and that was built in 2 phases, 288 units built in 2 phases, 02 to 06. You don't really have that on the West Coast because in California, everything that was built between, call it, the dot-com bust, 01 and the GFC 07, 08 was really all condos. They didn't really build much for rent multifamily. So that doesn't exist for us to buy. Whereas here they did. They built a ton of garden style for rent multifamily, and we're able to buy some product that's a little bit more light value add, and we don't have to worry about systems, plumbing, electrical, everything is more up to date. We don't have to change out old Zinsco panels where, they can catch fire and you've got some life safety issues, which, makes value add here, I would say, a little bit easier.
Yeah, I can definitely see that. You're not worrying about aluminum wiring. You're not worrying about asbestos and lead paint and all this kind of fun stuff that happens with properties 70s, 60s, and before. But galvanized plumbing, that's a huge thing out in California too. I see it all the time when I talk to other developers out there. So when you're down here, because I mean the Southeast loves the garden style apartments, that's for sure. So you have more than enough inventory to look at. What are common mistakes you see when you speak to other real estate investors?
That's a good question. I think something that you see and something I definitely saw on people doing a lot of business in LA over the past 6, 7, 8 years is underwriting an exit cap that's too low. I mean, now with what's happened over the past 6 months, it doesn't look as bad. It's masked that mistake, but I saw a lot of guys do very poorly in, let's say, 2017, 2018, 2019, because they were buying a lot of rent control product and, 14, 15, 16, thinking they're gonna turn a lot of units and buy out and do that whole thing and re-tenant it and sell it for a 4.5 cap, but they weren't able to do that because a lot of the new product was selling at, kind of 4.25. So why would somebody buy a 1960s renovated rent control product for 4.5 when they can go buy 2018 product for 4.25? And I saw a lot of those ultimately sit on the market for months and months and just trade for much higher prices for much higher cap rates and lower prices because there wasn't demand for fully renovated rent control product in SoCal.
Interesting. When you were going through 07 and 06 and 08, how did you kind of weather that? You said you got rid of a lot of properties in 07, but I imagine you still had ownership in some properties going through. What were some of the tactics and strategy you utilized to get you through that period?
So we sold most of it in 08. We had a couple properties trickle into 09, which we ultimately sold also. So we didn't have any legacy assets throughout the GFC other than, call it the first quarter of 2009. And on those two properties, one of them we actually sold at a profit because we had increased the NOI by so much. And then the second one we sold at a small loss, but we didn't have any investors in that deal. It was just me and my partner. So we just lost a couple bucks on a deal that we owned on our own. And the way we looked at it is, let's just sell, even though we're taking a loss, let's just sell it because that'll free up the cash and allow us to buy non-performing debt and REO, which was much more high octane than just sitting on an asset for the next 5 years so that you don't, quote unquote, lose money on it. And it doesn't show poorly on your track record. So we didn't care about that. That's a small way of thinking. And we just, want to get the cash out and reinvest into something else, which ultimately, in retrospect was the smart thing to do.
Yeah, that's fantastic. I haven't heard other people doing that before. Some people held all the way through. On the property that you increased the NOI on, was it just a very heavy value add, or was it really mismanaged, or was it a mix of both?
Both. It was very, very heavy value add. It had low rents. We were able to improve the asset quite a bit and drove rents substantially.
Yeah. So that's great for any listeners. If increasing the NOI allows you, I imagine if you ever wanted to refinance that or anything like that with that increased NOI, he adds value to the property and he has no problem, even if they scale back their loan to value on the refinancing. So that's a great tip. So Max, what are some main factors that have contributed to your success over the years?
I would say taking calculated risks is huge. I left a very well-paying job at Marcus. I was doing really, really well. My partner was doing fantastic at HFF, and we started from scratch, buying our own deals and, ultimately scaling that business. And we took, that was obviously, a big risk doing that. And then we took a lot of risk along the way and, continuing to scale and hiring more people and signing office leases with big rent and taking on space so that we can hire more and grow internally. And then breaking out of our comfort zone, 10, 12 years ago, buying outside of SoCal. And then we started buying in NorCal and other secondary and tertiary markets. We started buying in Fresno and Sacramento, and then we started buying out of state. And, that was a new risk for us. And we started buying in Oregon, and then we started buying in some other markets. And just don't be scared to break out of your comfort zone and grow.
Interesting.
Here I am today in Miami, I took a risk 3 weeks ago and moved my whole family to Miami, and we're taking a risk with a new office here and new staff, and we're hiring. We already made our first hire, and we're looking at employees 3, 4, and 5 as well down here in Miami. So, you got to just continue to take that risk and scale.
Nice. So how can our listeners learn more about you and your business, Max?
Well, you can go online, you go to tryonproperties.com. Actually, right now it's tryon-properties.com, and we've got a lot of education on the website. You can sign up as an investor. You can log in and create an account. I believe it's at the top center of the page. We just changed where that link is. So definitely create an account and be added to our distribution, and you could see all of our materials on what we're buying and what we currently have out there, our fund, any new deals, and learn a lot about our company.
Awesome. Well, thank you so much for coming on today, and looking forward to connecting with you here in the near future, especially now that you are down here with me in Florida.
Yes, great to be here. Thanks a lot for having me, Charles.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.